But the main point I would make about the problem with owning shares or stock in a physical ETF is that it's a form of credit. You don't own the bullion. All you have is an obligation from the manager of the ETF to deliver a return to you, which is not in bullion, but it is linked to the bullion price. So that is not owning gold. I mean, there are all sorts of stories, now, I have been involved in the past in producing prospectuses in London, and we're looking at London-based English law prospectuses. And the lawyers will tell you that when you put together a prospectus of any sort like that, you put in every sort of exception, which means that it's very difficult for you to be sued. Now, you could read that prospectus and take the view that there's so many loopholes in it that they're bound to exploit the loopholes. Now, we do know that the large bullion banks are very arrogant when it comes to the relationship with the regulator, and the regulator is almost frightened to go and talk to them. So there is room for bad behavior, if you like, on behalf of, say, I don't know, I'd be reluctant to accuse a trustee of this. But you can see that it's not necessarily wholly watertight. And not only that, but the dealing facilities and all the rest of it are really exempt from quite a lot of regulations. So this builds, I think, a load of suspicion. My feeling is that basically the bullion is intact in these big, where it's, I mean, you've obviously got variations on deliveries and all the rest of it, but basically the core of it is intact. But what happens is that authorized participants, in other words, the bullion banks who are listed in the prospectus and allowed to submit bullion in or take bullion out in return for shares, either shares being created or being redeemed, as long as they take them out in amounts of, I can't remember, I think it's $500,000 or something. It's really quite low now. I think what they're doing is they take it out and deliver, rather like the old carry trade. So I think they're doing a bit of that. So I think you need to monitor the short positions in these. Because I think those short positions are created so that effectively you can borrow stock, let us say, from an insurance company or a pension fund or whatever. Submit it to the custodian, the trustee, whatever, and get bullion in return, and then you can deliver that bullion into the market. So I think that's the sort of thing that's going on. But the main point I would make about the problem with owning shares or stock in a physical ETF is that it's a form of credit. You don't own the bullion. All you have is an obligation from the manager of the ETF to deliver a return to you, which is not in bullion, but it is linked to the bullion price. So that is not owning gold. I mean, I don't know. I don't know about the tax positions around Europe, but we have a wonderful facility in this country, and that is that gold sovereigns are legal tender, and they are free of capital gains tax and free of VAT. So you can own something. You can own physical gold, effectively free of government taxes. Now, That may well change. I don't know. But there is a problem. And that is that because the sovereign is legal tender, you can't really tax legal tender. In other words, it's money in law. And in fact, actually, gold or gold coin is legal money for all the successors of the Roman Empire, including the empires that we created. And this is why it's still legal money in America, because they imported our law, if you like, before they even sort of set up their own laws, and so that has persisted. But to give you an idea as to how important it is to own some gold, as late as 1932, you could exchange one sovereign for a pound note in the Bank of England. Or you would probably you would submit a pound note for a sovereign. So 1-on-1. Do you know what the price is today? £562. That is an indication as to how the purchasing power of paper sterling has depreciated in the last 90 years. And the interesting thing is that the value of gold over the long term is reasonably constant. I mean, it's not, it does go up and down a bit, but, I keep on telling people that, you've got a very good source of information on this. Diocletian's Edict of Maximum Prices, which is about 302, 303 AD. You can look at the items there, so-called maximum prices, and you can see quite a lot of items which are similarly priced today in gold. We all know that, the way to really make money has been to buy residential property, owning the roof over your own head and all the rest of it. But if you actually adjust the value of property and price it in gold, since 1968, when statistics in this country were produced by the Royal Institute of Chartered Surveyors, the value of property has risen by something like 30%. That's from 1968 to today. So we're talking about 55 years. 58 years, 57 years. So, and I think actually, if you took that from more or less the time when Bretton Woods ended, you'd find actually there's not very much change in the value of property measured in gold from then to today. Obviously, you've got the use value of property and all the rest of it. That's undoubtedly true. We're just looking at capital figures. But, the idea that, you've done incredibly well investing in property and all the rest of it, it actually is not nearly as good as you might think. If you look at the ETF statistics, collated by the World Gold Council, European demand for ETFs, physical ETFs, is actually moribund. Yeah, net demand, obviously, you've got sellers, you've got buyers, but the level of outstanding ETFs owned by Europeans has not gone up. Now, you're telling me that, I think, if I'm understanding,
we have record month after record month. Yeah, so it means that people understand that if you want to own gold, and in order for it to work properly as an insurance, you actually have to have the physical stuff and not buy shares in ETF. I guess people are understanding that. And also by listening to you, by listening to these types of podcasts, I think that knowledge is spreading, and which is a good thing, I think.
And also, I understand. Germany is a case in point. ETF demand not there at all. But I understand from a friend who is very much involved with the German bullion scene, that there is substantial demand in Germany, which is very, very good. I just had an email from him last night, which is great. That cheers me immensely, because what I'm interested in, I think, I'm sure what you're interested in as well, is that people should protect themselves as much as possible from the implosion of the credit bubble, which, is the biggest credit bubble in history. We've never seen anything like this. And all credit bubbles come to an end. And when they come to an end, usually it's a violent end. And when it happens, you'll find that the so-called price of gold will be, God knows what. The purchasing power of a currency will be, zero, going towards it. And you'll say, well, I wish I'd understood this one earlier. But governments have been very, very careful for you not to understand the difference between money and credit. So people are beginning to understand. And I think it's really driven by the price more than anything else. You see gold going and hitting new highs. And you think, oh, we haven't got any, or what's going on? Or so that is generating the interest, but it's the wrong reason, really. I mean, and what I try and do is to try and make people aware of actually what's going on. And it's not gold going up, it's their currencies going down. And when you understand that, the gold price is irrelevant. It's the most important point, I think, that you could possibly learn today.